Hello and welcome to Morningstar. I'm Francesco Lavecchia, and today with me is David Schwartz. He's equity analyst at Morningstar and is our expert in the apparel industry. So, David, as you said in your last policy report on the apparel industry, 2022 results were affected by a worsening macroeconomy. Can you provide more color on the weakening sales as compared with 2021 and why companies had higher operational costs?
The year 2021 was a very strong one for the apparel industry due to the high levels of consumer spending after the worst of the pandemic had passed. At the same time, there were shipping delays that caused low levels of inventory in the industry. This allowed for strong full-price sales and high margins. Then, in 2022, consumer spending slowed down as shipping resumed normal patterns, leaving many retailers and manufacturers with excessive amounts of inventory. This situation caused widespread discounting. At the same time, shipping rates, wages, and prices of commodities such as oil and cotton rose dramatically in the first half of the year, putting further pressure on margins. Inflation has become less of a concern in recent months, although consumer spending has been generally soft.
Now, considering the financial strength of the apparel sector, distress metrics suggest the industry is very polarized. About half of the companies we cover are very healthy, while the others are suffering. Do you think it's because of the differences in business model between apparel manufacturers and the retail stores? And do you think this is a temporary situation?
It is generally true that apparel retailers are struggling more than manufacturers as intense competition and rising costs have put pressure on retailers' margins. The retailers at greatest risk of distress are department store companies such as Nordstrom, Macy's, and Kohl's, and mall-based clothing stores like Gap. We rate all of them as no-moat companies. As for manufacturers, they tend to have lower overhead costs than retailers as they do not have to staff and maintain large numbers of stores. The manufacturers with the strongest financial positions are those with pricing power, such as wide moat Nike and narrow moat Lululemon. For most apparel companies, we believe their financial metrics will improve in upcoming years as global economies recover from the pandemic and inflation subsides. We do not believe any of the apparel firms covered by Morningstar are at risk of permanent financial distress.
So now, considering market valuations, which segment appears to provide the best value, and what's your favorite stock?
Most department store stocks are trading below our fair value estimates and have PEs below 10 times. However, there are undervalued stocks in all areas of the apparel industry. My top choice may be VF Corporation, which markets Vans, The North Face, and other major apparel brands. VF has had a lot of problems over the past year and has recently cut its dividend. Even so, we rate it as a narrow moat company based on its branded tangible asset, and its stock trades at less than half our $61 per share fair value estimate. The expected announcement of a new CEO could provide a positive catalyst.
Very good, David. Thanks a lot for your time and for your insights. For Morningstar, I'm Francesco Lavecchia.